Well, I think on the origination side, I think they really need to understand you need to work it from the end backwards. Okay. So even if you don't intend to sell a note, you probably need to structure it and look at it as if in the event that you do. Okay.
Right.
This is on the creating side, right? So you want to make sure you do it so you don't have to go have a fire sale and end up having to scratch a check to get out of the deal. That's number one. So you want to know, like, what would somebody, what would the indicative bid be on the note if it's created this way and it's underwritten from the RMLO and everything's stacked correctly. You need to know what the market will bear if you're going to create. That's my opinion. Okay. On the note buying side, it gets back to, what's your propensity for risk? Okay. Because everybody has a different definition of risk. And some people, and a lot of people have a different opinion on what a solid return is. Okay.
Yeah. Hey everyone, Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello, hello.
Hello. It's been a crazy time. New Year's has approached us and we're starting out 2023 in a little bit different way. I think a lot of our angles have changed. After the last month or so, we've been talking to a lot of different investors, different people inside the space, because we've been used to bank originated notes.
Yeah, it's again, one of the cool things about this business is it's pretty easy to pivot. You can go from one thing to the next. There's so many different ways you can tackle notes that it allows you to kind of change directions fairly quickly. And there are so many different directions you can go that it just gives you all kinds of opportunities, all kinds of options. It's great.
So, we got into this space years ago, and what we looked for was the opportunity to just invest and make money on our money. I spoke to Rhea last night about, landlording and, the struggles with that and how this is similar to landlording with the idea of passive income and fix and flipping and renting and stuff like that. And one thing we focused on in our 12 plus years doing this is been bank originated, clean, nice paper, and running on numbers. And I'm not sure how long ago we did a video with Tracy, and we found how large this other world is of note investing, or actually creating notes.
Yeah. And it's funny, because when I started notes, the beginning of my note career was creating notes back in Columbus, Ohio. And I actually really liked doing it. I stopped for a while because it was in 2012 and Dodd-Frank came into play and I couldn't find an RMLO. And so I knew that was a thing, and I knew that was something that needed to happen, but I couldn't find one. So put that on pause, which was totally fine. Like we say, you can pivot pretty easily.
Yeah.
But now we're kind of finding our way back that direction and getting back into that seller finance world.
Yeah, absolutely. And in the fact that when we hear this 30 billion originated, it's nuts.
Yeah.
I'm glad everyone's jumping in here. A billion, like not million, $1 billion of seller finance originated in 1 year.
Yeah. So that's huge. So the opportunity there is massive.
Yeah. When we talk about this stuff, we're all about numbers and whatnot. And what we're finding out, is that this world of seller finance doesn't have a good connection to the world of note buyers. And what we're realizing is that could we basically do this in a way that we can bridge a gap, basically fund them out and let them keep going, and they're happy to do that. So we have two groups of people joining us today. Unfortunately, Mark had an emergency, he couldn't come. But what we're finding is we're going to bring the note buyers together with these originators and sellers of originated notes and let them know you can sell a note, make a great return, and go do it again.
Yeah.
You don't need the bank. You don't need anyone else. You can come to us. We'll buy you out. Getting into wraps, getting into all the kind of things. And for these originators, we need to clarify to them, what kind of paper are you creating it? Are you doing it correctly? What are some of the gotchas that note buyers look for so you can refi out per se?
And that's just it. You know, it takes me right back where when I first started originating paper, as I learned more, I learned how I was doing it all wrong. And I had to make all kinds of adjustments and fix a bunch of things. And we're kind of finding that now, like people that are in that same boat where not necessarily they're doing it wrong, but for our purposes as note investors, we focus on different things, and we need to have things lined up the right way in case of whatever, and just having clean paper that we can deal with for whatever it is we need to deal with it.
Yeah. So when we got into this idea of originating notes, it was something I'd never done before, right? And we're slowly learning what comes together with that so we can buy your paper. But what we want to lean on today is creating that paper, the legitimate paper, right? But also on the flip side, making sure your numbers are built well enough into that note that when we make an offer, we're not going to scare you away. Right? Yeah, exactly. So, like I said before, we unfortunately, Mark had something he had to come up with, but we do have Nick on here. Nick has been someone that has been around the space for a long time. Nick's been someone that I met years ago, didn't realize I did at a no conference. But it's amazing where the connections come back when we get on a phone call and you start talking about these things. We're in the same game as Nick is, which is really cool. And his group of people and his Facebook group and everything else, and us can build a huge bridge to connect everyone together, right? Do everything right over here. You can sell to us and refinance everything. So, Nick, I appreciate you jumping on this morning and spending some time with us.
Awesome.
And your knowledge and experience, not only for us, which we're going to learn today, but also for how to create the notes to sell.
Right.
Can you give us a background of how did you get into real estate?
Yeah, well, now it's funny because now the cool thing is to listen to the old guys, right? Because the old guys were around when this crap hit the fan in 2007, 2008. Yeah. I speak a lot, and I was at an event, and there's maybe 300 people in it, and I asked the question. I go, hey, who was around? Raise your hand if you were around doing real estate, not even notes, just real estate in 2007. And you could count on two hands the number of people. And I go, that's the problem, right? It's not that there's a problem with being in real estate, and there's a lot of things that I wish I had available then that I do now, but you don't know what you didn't get the chance to experience. I wish I could show you this picture. My dad sent me, this is hilarious. He sent me a clip. I got to read this to you because you guys will not believe this if I just said I don't want to mess this up. He sent me a clip from an article in the newspaper from 1982. CD rates. The yield was 14%.
Holy cow!
14%. Can't make it up. I'm looking at it right here.
Wow.
Are you kidding me? He goes, that was when I didn't have any money. He goes, when it used to be 18%, he said.
Yes.
I go, people don't this is where I'm trying to get to right now, is that rates are not high, guys, right now.
Nope.
If you go back in history of time and you look at what mortgage rates have traditionally done, this is only high relative to what we've been experiencing literally the last 5 or 6 years. Because in 2007, 2008, rates were probably even a little bit higher than they are still even right now. So the reason why I bring all this up is because like you said earlier, you have to be able to make pivots and changes. So when I first I started out as a real estate investor. Okay. So I have the experience of being on the real estate side. And then I went to the dark side, which is what I call the notes, right? So the notes, I started a company in 2012 with my partner, John Montero, a company called Rilex Capital. Okay. And the whole point that we did, we built that business to sell, and not that we knew that we were going to sell it, but we knew that if we used and implemented best business practices, then it would benefit us regardless if we stayed in the deal or not. Well, fast forward to 2018, we actually end up, and this was a seller financing business, okay? It was creating notes from scratch, buying properties, fixing them, selling them to owner finance buyers that were not traditional bank borrowers. And we end up building this huge seller financing business, wrote hundreds and hundreds and hundreds of notes. And we end up selling that business to literally 100-year-old federally chartered bank. Okay. So it was, I joke about it because it was like a 9-month proctology exam, because I mean, if there's anybody that has more overhead and compliance issues and just regulations and regulators, it's the banking industry. So the reason why I bring this up is because I don't know everything about everything, but I do know that for us to be able to be successful and do what we did, we had to know, I had a pretty good idea of what we were doing. And so as a result of that, brings us to where we are today is where we have with the USA Note Pro and the Creative Deal Maker on the teaching people how to do that same strategy.
Right.
It allows us to create bank quality notes that other people just either don't know how to do or don't know where to go, right? So really, really important, because when you look at that $30 billion market and industry that you talk about, which is all the notes that are created that aren't written by Bank of America or Wells Fargo or Chase or whoever, they're individuals, right? They're people that are listening to this call. They're mom and pops, they're one-offs. Now, I'm a professional note writer and this is what I do, and there's other people that do it as well. But in that whole universe of the 30 billion, less than 5% of them do more than 4 notes a year.
Yeah.
Okay. So it's a very fragmented business and industry. Well, the problem with it, in my opinion, is that people write all these notes, but they're just not well properly created, right? They're missing things. You know, we talk about this all the time when you go to, there's a lot of people that teach you how to go evaluate a note, but very few that I know of, at least, that tell you how to structure it at a bank quality level. So to your point, you can get maximum value, because at the end of the day, let's be honest. Do you want something that's shiny and new and you know it's going to perform? Or do you want something that's used and maybe it does and maybe it doesn't, right? That's why banks don't sell their notes a lot of times to people like you and me.
No.
Guess who buys them all? Fortune 500 companies, hedge funds, private equity groups, family offices, guys that buy, tens of millions of dollars of notes, and they pay a premium for the paper.
Yep.
But why is that? It's because it's all about asset preservation to some point. They don't want to manage a problem. Just like banks don't own real estate, they control real estate. They don't want to own it. Nope. When it gets into the secondary market, the last thing they want to do is own it. They don't want to own the property. They just want the cash flow from the note. And
they want to lend. They just want to lend.
They just want to be a lender. They just want to control. Now, there's people that will say, well, I can fix anything, so bring it on. Cool. There's a place for them in the world too. But I'm going to tell you right now, the last thing I want to do is have to deal with a non-performing note or have to deal with the landlord, be a landlord, or be deal with a tenant. I don't want to do any of that stuff, because that's a job. And not really looking for a job.
So why did you start creating notes? Like, how did you go from the real estate?
That's a great question. I always get asked how I got involved in this and how I got started. And it's been a long time now, man. I started this a long time ago. And it sort of was, I got a little bit lucky, I guess, to a certain extent, because I didn't understand amortization back then.
Yeah.
I didn't understand why, but now I do. And once you understand how amortization works and why banks do what they do, you go, holy crap, why would I want to ever be anything but a bank?
Yeah.
Honestly, why would I want to own, like, here, I always say this, I want to own notes relative to single family residences, but I don't have a problem owning assets that is commercial or multifamily or something like that, just because of the nature of the two types of assets. But to your point, so I started seller financing a long time ago. I had a property. I came out of the crash. I did everything wrong before. There wasn't education. There wasn't Zoom and Facebook Live and stuff like we're doing right now on YouTube to really educate people on how to prevent from making mistakes. That's why I'm so animate about doing things like this to help educate, because it's really the key to understanding what you can do, but also what you don't want to do. And I made a lot of mistakes. I didn't have REI clothes back then, didn't have education and like we have it today. And I had a property and I bought it, or I didn't buy it. They mailed to a list. I got a property that came in, and this was a long time ago, and it was a cheap property. I mean, super cheap. And the lady goes, I want to sell it. She goes, but there's a tenant in there, so please don't go disturb the tenants. I'm retiring from General Motors. I'm moving to Florida to be with near my grandkids. And I said, fine. So I drove by the house and I go, oh, that's what a $25,000 house looks like. Remember, this is a long time ago, right? You can't point at a 25,000, is $100,000 house. It was a little 2-bedroom, 1-bath POS, 700 square foot house. And that's what you would see today. And this was in Dallas. It was what you'd see today at maybe $80,000, right? If you can even find an $80,000 house now. And so I was driving down the street and I saw a sign that said Vende Casa. I know Spanish to be dangerous. So I called him, I go, hey, I see you have a house for sale. Do you know anybody that might be interested in buying it? And so forth. So we went down that path, and, long story short is that we, found out that there was a lot of people out there that needed financing that could not go down to a bank and get a traditional bank loan. And now it's even more prevalent today than ever. Because here's another, fast fact, or whatever you want to call it. Talk about the $30 billion market. Yeah. But you know what else there is? About 60 to 70% of the population can't even go down and qualify for a bank loan.
Right.
Okay. So when you think about this, and this is what sort of drives me a little bananas, to be quite honest with you. If up to 65 to 70% of the market can't go down to Chase, Bank of America and get a bank loan, okay, and less than 5% of all properties available for sale are available through creative financing, you think that you'd have them lined up 100 deep to be able to get into that house, because you can provide them the ability to have home ownership when banks have told them no. So it really sort of baffles me when I see this poorly written paper and poorly underwritten buyers, because there's really no need for it. There's more demand for owner financing than there is for retail right now. And that's not going to change. The other thing I want to say about that is that people always there was always a negative connotation relative to seller financing for a long period of time. They thought it was stuff that a bank wouldn't lend on, for example.
Yes, exactly.
Or they thought that it was a bad buyer, but the numbers say otherwise. I mean, I think the average now for owner financing is like over $200,000.
Amazing.
Amazing. So, but to your point, when we can get into this in here, the deal structuring is where the value comes in. Okay. People say that you make your money when you buy the asset. Well, that might be true in a traditional real estate model.
Correct.
And in the note side, it's not that at all. It's how you structured the note.
Yeah.
How you stack the collateral file. Did you do a contract for deed versus a mortgage or deed of trust?
Yeah.
Okay. Is it in a judicial or non-judicial state? Are you servicing it?
Yes.
Did you use RMLO? All these little things are the important characteristics that add up to a premium note that like banks do. And I always say it, and then I'll let you guys continue on, is that what would a bank do?
Correct.
That's the first thing I asked the question. What would a bank do? Okay. Would a bank do a contract for deed? No. Why would you need? People could do contract for deeds all the time. And I'm not saying there's anything wrong with the contract for deed.
Yep.
I'm just saying banks don't do contract for deeds.
Right.
And why is that? Because they don't need to.
And they don't want to own property.
They're perfectly protected if they write the promissory note and everything correctly. They don't need, and if they underwrite the buyer correctly, they don't have to, they have a good borrower, right? I mean, seller financing does not equal bad borrowers, okay? Right. It just doesn't. It just means that they might not check all of the boxes that a traditional lender needs. Their DTI might be a little bit off, or they may have only been in.
That's debt to income, by the way, for those who don't know. DTI is debt to income.
Yeah, sorry. Their credit score might be not up to the minimum. There's another fun fact. Okay, haven't seen the latest numbers.
Yeah.
But up until when I checked it the last, the average declined credit score was 708.
Wow.
Decline.
Wow.
The average. I mean, are you kidding me?
Yeah, that's
I mean, 708 is a good credit score.
yeah. Yeah.
I mean, I'm just telling you, my credit score is not 708, but I manage credit. I use it. I leverage it.
Yeah.
It goes up 50 points, down 25, up 75. But that's just the way I use it to my advantage. So I can never go down and get a traditional bank loan. And I'm fine with that because I don't need to. I can do things that we're talking
So I
about.
think a lot of people, when they create these notes, they think from the borrower's point of view, and they try kind of, I need to get a borrow in place, and I write notes, originate, but they don't realize the other side of the space of, if things don't go right, how are you in a spot where you're not going to have a problem, right? If your borrower defaults, are you going to have a heartache going to foreclosure because maybe you originate too many loans for the year, or you didn't hire a licensed originator?
Yeah.
Maybe you didn't underwrite it at all because you did a land contract, not realizing that you need to underwrite land contracts if the borrower is still in the home. So when you use these kind of things, now underwriter, granted, if you're experienced, you can underwrite yourself. However, we do have Max Call Underwriter in the back end here, off camera, but you have to understand that when you originate these loans, everyone does this kind of stuff. But if you don't do it correctly, that's the first step for a note buyer to say, I'm out.
Well, look, and to that point, well, and they might not say they're out, but it's going to cost you in the discount,
Yes.
right? And here's what people don't understand. When you give up that discount, you never get it back.
Yeah.
It's gone forever. And if you understand amortization, you look at the effect of that discount inside of an amortization table, it's a hell of a lot more money than the hard number that's on top of it.
Yeah.
So one of the things that we do, and what I do, and what I didn't do in the beginning, is now we write first and second lien mortgages. Okay. And the reason why we do it is to what we're saying, because we're thinking of it from the note buyer's perspective. And what are the main things that a note buyer is looking for when they analyze a note to buy, right? So
you mentioned discount. I wanted, for those who may not know what that means. So discount is there's a balance of the loan, either at origination or current balance, and we're going to pay less for that. I give the example like a lottery, right? When a lottery is $1 billion, you don't get $1 billion, you get $500 million, right? So you're going to get a discount based on the unpaid balance because of the fact that you're getting money now versus later. So the discount off of what the balance.
So you have time value money. That's one, but there's other things too, right? There's how what is the
states? There's the interest rate. We're gonna get into all that, but we want to start first off originating good paper, solid paper, right? Writing a piece of paper on a writing on a napkin what the terms are for a borrower doesn't always equate to a good, solid, sellable note. Not saying if you never sell it, it's not good, but if you default or you want to sell it, it's not clean paper.
I would say that is probably the number one. So this is probably the number one thing that I see across the board more than anything, is that when people go and they want to create seller financing, okay, and they go to a title company, most of them still use a title company. Some do not. They do whatever. But what happens, they have somebody prepare their documents, okay, their lender documents on their behalf, okay? And, Maxim probably talked a little bit about this too, but when most do, they prepare the lender documents from a legal perspective,
right?
Okay. So they can file it, they can record it, they can do everything from a legal thing. But let me tell you something. I could give two rips about the legal side of it if it doesn't meet the lender side of it, right? Because there's certain things that we need to have that they're written, like how is servicing addressed in your promissory notes, okay?
Yeah.
Servicing is a lender, a title that you hire from a title company, an attorney that crafts it. Are they even going to ask you about servicing unless you tell them about it, right? Probably not, because it's not a legal requirement, right? Well, let me tell you something.
You can service yourself, but those who are getting into notes or want it, I recommend getting with a servicer, because
100%.
If you do things wrong, you violate federal law.
Well, that's a whole nother issue in itself. But if you, for example, you say, I'll just self-service it, great. So that's fine. Well, that affects the yield when you go to buy, right? So that's a huge discount that you're going to have to eat at some point in time if you decide to sell and liquidate. But here's the other thing I see a lot of times when people do it, they'll go in and they'll put in the dollar amount of the servicing. For example, $20, $25, $30, whatever it is. Okay. Well, let me ask you a question. Do you think 10 years from now, servicing is going to be $20 a file?
No.
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 You
Exactly.
think 15 years it's going to be $30 a file? For all we know, with inflation, it could be $100 damn dollars a month, maybe 200. We don't know, but guess what's not going to ever change? The borrower's payment. The borrower's payment will never change until it's paid in full. Right? The principal, the amount of money that goes to principal versus interest, that will change, but the dollar amount will not change. Really, really critical to make sure that you're writing promissory notes, even for your own benefit, even if you don't say you want to sell, you got to write them with the right thing. That's why we have the transaction management company to do all this stuff. So people don't, it's like gun safety. Okay. I can give you a loaded gun. Okay. But if I don't teach you how to use it properly, you're going to maybe hurt yourself or somebody else. And I don't want to be responsible for that. Right. So nobody does. So you got to really understand it. And just because an attorney does the doc prep doesn't mean they're doing it for the things that we need to have in place. Super important, super critical, because that's going to have a tremendous impact on the value of the note when you go to sell it.
Yeah, absolutely.
Nathan, I know one of the things we ran into recently is the servicing question.
Yeah.
For those people originating notes. Yeah, I'll let you share like what we're running into so much of people originating notes and the servicing they're thinking they're doing.
Yeah, because a lot of people are coming from a traditional real estate. So they're thinking about rentals, which is fine. And rentals is a great.
I know exactly where you're going with this.
This
is scary.
But then the problem is they have a monthly payment of say $650. And that $650, they'll just record it as $650 every month coming in. They haven't even touched amortization. And what happens if 1 month they're paying 625 and then the next month they pay 653 and then they pay, a late fee here and a late fee there and all of those things. If you're just taking it dollar for dollar, that could be a huge mess. And like, let's say that the payment actually, according to the terms of the loan are actually $648, but you're collecting $650. Well, that affects what the principal balance is over time. So you can track it yourself, but unless you have specific software for notes, not for rentals, you're not going to have accurate numbers.
We're running into a lot of people using apartments.com.
I never heard of that till like a couple of weeks ago. I go, what the?
Yeah. So when I asked for a pay history, they showed me a list of dates and payments.
Or another thing they were doing is they'll collect principal and interest and tax and insurance.
Yep.
But then they don't separate it out. So they'll have, a $700 payment. Well, $650 of that is the principal and interest, but then they were attributing the extra $50 to the note as well. No.
Yeah.
That's
let me
tax
say
insurance is a separate thing.
This is really important. And Max will be able to chime in and appreciate this too. When Dodd-Frank came into play, okay, everybody goes, oh my God, this is horrible. They're trying to cut the seller financing guy out of the middle because they're taking deals from the bank, whatever. It's the best thing that happened to somebody that creates notes. And here's the reason why, because you got to use a disinterested third party, like Call the Underwriter, to come in and do something else. And guess who pays for that? I don't pay for it. The borrower pays for it.
Yeah.
Okay. Period. All right. Yeah. Just like they pay for the servicing, at least when I write my deals. So guess what I'm going to do? If I'm going to have, if the borrower is going to be responsible for that, guess what I'm going to do? I'm going to find the best underwriter to do my underwriting. I'm going to find the best servicer to service my notes. I'm going to find the best attorneys to create my legal documentation and all of that stuff. Because we're writing these notes for 15, 20, 30 years. I want to do it one time and get it right, and not ever have to screw around and worry about it again. Because here's the problem that people don't think about when they sell that property and they do seller financing. And they go, okay, I'll take the cash flow. That's great. Okay. But here's the problem. Of all those people that at 30 billion that we were talking about, they're individuals. they're individuals, not entities, right? So life gets in the way. Events happen. People get sick, lose their jobs, have weddings, need new cars, go to college, all those things. And so there's going to be a point at some point in the future that they're going to need to, maybe liquidate. So you want to make sure when it's time to liquidate and you haven't want to sell it, you get maximum value to what you were referring to earlier.
Absolutely.
Yep.
So let's back up for a second, right? We have different people out there, part of our watching right now. Nick, you don't do any kind of wraps, right? You strictly stick with seller finance notes, correct?
Technically I only do wraps.
Okay.
Just by the nature of the definition. However, I don't necessarily stay in them.
Right. So for those people with notes, wraps is kind of a new phrase. I've heard of it. It's not my understanding, Jersey doesn't allow it. But it's interesting. So when you create this wrap, what are some of the documents you need to have so that if it defaults, you can prove the case that your new borrower defaulted and you can foreclose on stuff?
Yeah.
And the fact that what do you need to get from the original borrower to make that wrap successful?
Yeah, so so technically everything that we do is a wrap because there's some underlying debt that's already in place. Okay. So by definition, it is a wrap. So if I have my own lien on the property and I leaned it, say I own a property and I leaned it with a company or something like that, and I go sell it. And before I sell, because I don't table fund the sale of the note, right? So if I did that, then I probably wouldn't need to do a wrap, but I have to do a wrap even for a couple of weeks because I have to get the everything recorded and then I have to sell the note. Okay.
So let me clarify what wrap is for those note buyers, because that was unknown knowledge to me. What that word meant is you have $100,000 first lien in place. A seller, for whatever reason, we won't get into whys, decides to give me a property that may be worth $200,000. I take over that $100,000 first lien, and then I create a secondary $100,000, but combine the other 100 to make a $200,000 note for a new borrower. I'm going to pay the first lien continuously or pay it off, either way. And then I will make the proceeds of a $100,000 gain on that situation, right? The transfer deed happens. What do you need from that original borrower to make that happen?
Well, that's a great question. So I would defer that to my attorneys that are doing all the doc prep.
Yep.
Because you're going to need stuff like power of attorneys, at least limited power.
So let's back up power attorney. What is a power attorney generally for in just general terms?
It depends on what what kind of transaction you're doing, but let's say you buy the property subject to, which means an existing debt of some type. Okay. And you need to be able to communicate with the underlying lender, and you're not going to go back to the seller to do it because maybe you need to get an updated statement, or you need to get an escrow analysis done or something like that, right? It's limited from the standpoint it's more for informational purposes, okay, not for financial purposes, if that makes sense.
Yep.
Okay. So, those are the main things, because it depends on how you acquire, right? But the wrap just means that there's some underlying debt in place that causes to be a wrap. So we have to disclose that. You have to write the documents to your buyer and let them know that. It's done through the attorneys that are creating the lender documents. On our side, we do not usually keep the wrap mortgage in place very long. Okay. For example, we buy a lot of stuff using hard money or private money. Okay.
That's it.
So let's do a quick analogy. I'm all in it for $150,000. Okay. I'm in it for $150,000, and I borrowed it with private money or hard money. Okay. Well, they're going to lien that property. So they're going to show up as a lien holder. Okay. Well, the only way they're going to release that lien for that money is to get paid in full, right? More than unless you're doing a whole nother thing, but they're going to want to get paid in full. So the only way, what we have to do, or what we do, and we let them know, and it's not, then no one has a problem with it. We have to create wrap documents first Okay, so it's almost like buying it subject to the existing $150,000 hard money loan in the wrap documents, but we already know what we're going to do. Once that note is created with our wrap buyer and it's recorded, then we can go and take the note, sell it. Okay. And then if you're a note buyer, you're not going to buy that note unless you're in the first lien position, if that's what you're buying. So the proceeds that come in from that is what actually goes to pay off the seller and get the lien released.
Gotcha.
So
That's what a wrap does.
when you sell the note, you are paying off that
It has to get paid off.
underlying debt.
Well, that's the only way I do it.
Yeah. And
We wouldn't do
for
it
me,
anyway.
that's my preference. We just talked to somebody this week where they would keep that outstanding loan out there, which
That's
is
what
fine.
some guys do that. Like, so
Yeah.
what we'll do sometimes, and I don't want to get off in the weeds on that, but if we get seller to say that seller carrying that to us,
Right.
then we might do a what's called substitution of collateral, right? So it lets me go do whatever I want on the wrap side. And if I sell or do whatever, they just want to get the payments. A lot of people just want the payments. So we'll just continue to make payments and then replace it with some other type of, like property or asset that allows us to let them lien that, because they still want to have their money protected in a lien position. So, that's pretty high advanced stuff. I mean, for most people, the strategies of what I think where we're at right now, where I think the biggest bang for the buck is we deal with a lot of landlords, right? So there's a lot of landlords out there that are just getting tired of being a landlord.
Yep.
And so how do you take the landlord and convert them from being a landlord into a lien lord, right? How to control versus own. They want cash flow, but they don't want to be, dealing with tenants anymore. So this is the strategy you do, and you can structure, and they can stay as much of a part of the deal. Look, you don't have to sell 100% of the whole note, right? Or the whole transaction. You can create a first and a second, sell the first, keep the second, or you can sell a partial, right? I mean, you guys do both of that. But getting back to what I was saying before, when we talk about why we write a first lien and a second lien. So when I go to sell the first lien, and I have it written at a 70%, for example, investment to value versus a 90%, I don't have to discount it as much because the note buyer is in much more favorable risk position.
Yeah.
Less risk position.
I wanted to just, from what we've been told, correct us if we're wrong, what we're hearing is you need to get a power of attorney to allow the new subject to buyer to speak to the first lien and to pay off, get the payoff balance and things like that, and have the ability to speak to them, and then get a what was the other paperwork where you get a authorization to speak on their behalf.
Yeah.
So I'm gonna put in our chat, by the way, the YouTube channel, so that you guys can see the replay.
Yeah.
What people are asking for.
And I would say this: if you're going to start, because here's the way I look at it. I'm all about disclosure. I am not I don't teach or educate on subject to. Okay, there's a lot of people out there that do and do a great job of it. But here's what I love about it: it still comes into the funnel to create the mortgage to a seller finance buyer. And then once it's there, then that's when it comes into the note world, right? Mm-hmm. Now we have these notes that we're able to creatively structure to our benefit on whether we want to stay in it or we want to exit out by liquidating it. That's the beauty of what we're talking about here, in my opinion. It doesn't really matter if it's a seller finance deal and the seller will carry, or it's sub 2, or you go borrow private money and do it, or you already own it. The exit for me and the structure on the back end never changes.
There's some questions coming in. We're right now live on Facebook, LinkedIn, I think Twitter as well. So, so one of the questions came in was from Cindy. I'm glad to see Cindy on. We have a bunch of people coming on. Is what happens? I mean, if the property sells, there's a call right from the bank. How do you?
They have the option of calling.
The option of calling, you're right.
Yes.
How do you avoid that option of call that the note already has in it? That, as the question says, get around the original lender, call the loan, since most existing loans are not assumable.
I don't know. Yeah. They have the right to call the note, no question about it. But I don't know. I've never had one called.
So I remember this question from a conference I went to in 2010. And since then, every single time I've heard it brought up, the question then goes out, has anybody ever had that happen to them? Zero. It is,
here's where the problem usually happens.
Yeah.
Okay. The problem usually happens in the fact that they don't do the insurance correctly.
Okay. I've never heard of it actually being called. I would love to actually hear somebody say, oh yeah, that's happened to me, but to date,
no.
Nobody I've ever talked to has ever.
I don't think there's any, I don't know of anything.
It's like the idea the IRS has a deadline after foreclosure to redeem the property.
Exactly.
But they don't.
Never heard of it happening.
No. So
you know what? It's like, yeah, I get, you know, I'm in 1,000-year flood zone. And I guess in theory it could flood, but it hasn't ever flooded, and it could.
The other question that came up from John was that, you know, does the power of attorney be in the state of him or the state of the borrower where the property is located?
You know, that's going to be I wouldn't even attempt to answer that, because there's like, our attorneys will create all that documentation relative to that type of transaction. So if you're trying to acquire something with a sub 2, you know, and you want to close on it, then there's a whole set of documents specific for that type of acquisition that we just utilize, that's been created by, you know, legal counsel that tells that has you do it. I would never go and try to do any of that on my own, and I wouldn't trust so do it. And every state's different. Yeah. Every state's different. You got judicial, you got non-judicial, you got different state laws, you got usury lists, there's all kinds of things that could impact that.
So in my experience, I'm up in Canada. So every once in a while I have it where I'm selling property, and what I've run into is that they require a US notary to notarize the signature, which is a pain in the butt, because now I live further away from the border than I used to. I used to just drive down. Now I'm a couple hours away, so it's not worth it. So what I do is I just issue a power of attorney for my realtor to go ahead and sign on my behalf. And so I issue it from Canada. They record it in the state where that property is.
I'm going to guess.
I don't know if that helps, but
I'm going to guess that it's where the property is located, because that's
my guess as well.
And you're getting a power of attorney from the borrower to act on their behalf.
Yeah, that's my guess.
I mean, at the end of the day, for me, and I've done this literally thousands of times, okay, and I've been doing it a long time. And one thing I'm not going to do is I'm not going to underwrite my buyers. I'm going to let somebody like Max do it. I'm not going to service my notes. I'm going to let somebody like FCI or Madison or NAMS or August REI do it. Okay. I'm not going to create my own promissory notes to save a few bucks. I'm going to let my attorney do it. And I'm just going to do it that way. And I'm going to build the deal. I'm going to make the deal work under those constraints, or I'm not going to do it.
I do that. I'm the stupidest man in the room. You guys do all the professional work. I'll run numbers.
There's no reason to make it any more difficult than that. It just isn't, you know.
Let's switch gears here, right? Yeah. We created this note. We have our power of attorney for wraps, and we have our idea. We're going to use a servicer because it makes sense, right? So we're going to talk about how to sell this note for the top dollar. What are the things that the originator, who may be originating notes now, doing that may be incorrect, right? And or can add on to a note to make it worth the most amount of money to be able to sell it tomorrow and not be surprised when they get a quote from us and going, holy goodness.
Maybe let's start with just terms. What kind of terms would be?
Right.
Well, that's a great question. I think the terms is probably, the terms of the deal is probably one of the biggest things, because look, you guys are note buyers. Let's look at the note buyer's perspective and work it backwards. What's probably the number one thing that you're looking for relative to buying a note?
Property, right?
The property itself.
And my return.
Look at the asset. That's number one.
I have the collateral file.
Yeah.
Right. I have the numbers. Right.
Yeah. So what's my return?
Yeah. What's your return? Right. Yeah. So your yield. Right. So if you are in, you know, and if let's just say you're trying to get a 10% yield. Okay. Okay. Well, and you're trying to buy a note from somebody. I don't care how good the collateral file is. I don't care if the borrower's got an 800 credit score and it's at a 50% LTV and a 40% ITV. You're not taking a 3% yield. Am I correct?
That's correct.
Never on a
let's-
million years.
So
No.
let's talk about things that we don't care about as note buyers. We talked about the last webinar in December. I don't care the borrower is a local handyman. Don't care. I don't care that
I don't.
when the borrower defaulted, what happened. I don't care. Right?
I don't.
care how you found the deal. I don't care what kind of fridge you rehab the property with.
Yeah.
Right? There's numbers that go into our world, right? And the note encompasses the 5 big numbers, right? We have our balance of our loan, we have our interest rate, we have our term, we have our P&I, and a balloon if there's anything, right? And how you stagger that. If you have a balloon in 2 months or 24 months or whatever, it's a mathematical equation to equal out my yield or IRR number. So when we say terms, that's what we're talking about, those big 5 numbers.
Yeah.
And
So
those are paramount.
interest rates
above
obviously super important when you write the note, because what
Definitely.
we're seeing, you'll see in this now.
Yeah.
Okay. I would never write an interest rate that low, right?
Nope,
And here's
yeah.
the reason, because rates were historically low a couple years ago, 3.5%. So a lot of seller financing guys go, well, you know what? The bank's at 3. I'll be smarter than the bank. I'll write it at 4.
Yeah.
Well, what is that getting you now? 50 cents on the dollar if you're lucky?
Yeah.
Yeah.
Maybe not even, right? Maybe 30%, 30 cents on the dollar. So that's one. I mean, I think that's probably the biggest.
Yes.
I mean, obviously the borrower file is important,
yes.
but I think and I think the other challenge that a lot of people don't really take into consideration, there's a big difference between what you sell it for and what the value of the property is.
Yes.
Okay.
Oh yeah.
And a lot of times that we see people, because they are offering seller financing, they want to sell it at a premium. Okay. So the house is worth 200,000. So they want to sell it for 220. Okay. Now, I have no issue selling it for 220 if it's worth 200. It's
Right.
if that's what the agreement is. But you got to understand that when the note buyer is going to go look at that asset to buy, they're going to base it on the $200,000 because that's their risk level, right? So you have to be able to adjust it accordingly to your point and figure out what that discount potentially is going to look like. Now, if you're going to stay in the deal and you can get it, cool. You know, here's another thing you can do. What's that? I'm sorry.
We compare similar to rentals, right?
Yeah.
Passively, a rental that's fully paying, right? The tenant's doing great. If you sold a tenant occupied property, paying occupied, most people pay based on the cash flow. We're doing the exact same idea.
Same thing.
We have a promissory note that we're going to get cash flow in, and we're basing it based on return. We may be getting private capital, we may not, but we want to guarantee an annual return for our dollars. And that's what we care about, the numbers. If it's performing or non-performing. Now, if you have a non-performing asset, that's where me and Nathan kind of grew up on, which is non-performing assets, because we were buying it so well priced and we can do all the foreclosure work. So if anyone out there has an owner finance note that's non-performing or in-performing, I'll drop in a link in the chat or reach out to one of us afterwards through our the link I put in before, where you can ask us, hey, I have an asset that I'm looking to sell. What would you bid it at? But we're going over one of the key items to make that higher value. If you send me a loan that's written at 5%, good luck. Good luck.
Yeah. The other thing
I'm
I think
still willing to buy it, but the discount's going to be big, and you may
Yeah.
not like that.
well, and the
So-
discount might be so big it
Okay.
becomes a loss, not a deal for the seller of the note, right? And I
Yeah.
think the other big part of this thing, at least it is for me, I don't know, because of all the notes that we've created, who the note buyers have been, is the underwriting of the buyer, right? And I don't mean it necessarily from, the fact that they got a 700 credit score versus a 600 credit score. I'm talking about all the documentation, the stuff that Max is here. Maybe we let Max talk about
Yeah.
how critical the RMLO underwriting process is, because for me, when it's done correctly, there might be 35 disclosures in this package. Okay. You got the Patriot Act. I mean, Max can probably talk about these disclosures. Are they important to me? Not really, but they must be important to somebody. Otherwise, they wouldn't have you doing them, right?
Yeah.
If you go to Bank of America and you go apply for a loan for a mortgage, guess what you're going to have? You're going to sign probably 60 different times on that loan package. Why is that? Okay. It's disclosure.
Right.
And, so we have to be able to take that into consideration. It and it gives people that are looking at a snapshot and taking a picture of the note and looking into what degree of probability will this loan perform, right? That's one of the things that we're looking at. And as a result of that, when you see a file that's stacked with 600 pages and has 72 signatures on the from the borrower, and you see another file that's written on a napkin, and they say that the borrower pays them every first of the month in $100 bills, okay? Which, you know what I'm saying? That's what we're trying to establish the risk, because risk is a really important part of this equation, and this is probably the one thing that you really can't, put a dollar value on, right? When you can't, it's hard to monetize or how to
Before we
assess
let
the
Max
value.
jump in here too.
Yeah,
really
let's talk about
other key
RMLO.
Yeah, so Max is a call underwriter. He's off camera. He said he has a face for radio, so we'll let him stay off camera. One of the things is you mentioned before states. Now, if you have a property in Texas, that's different than having a property in Illinois, New Jersey, South Carolina. Why is that? If it defaults, it goes through a legal process called foreclosure, which allows me to get a property back because it's secured by the note. Now, when I
It's
do
the exchange of title going from the borrower to me as the lender.
So I'm going to take the property back because I have a secured note. When I do that, what happens there is each state is ran differently, right? Texas, you can do it very quickly, less than 90 days. Where in New Jersey and Ohio, you're looking at over a year. So my pricing also has a timeline on it. I can return my capital in 90 days or 18 months.
Yeah.
So I'm going to price it with that risk level of saying, what do I get annually? In Texas, I may be able to do it 4 times in a year. So I can buy that at a much higher discount, knowing the fact my money will come back quicker, right? If it's not performing. Now, Jersey, I have to 18 months. I have to discount even more because it may take me 18 months plus all the property taxes included. So one of the key factors, if you can originate notes more in like the non-judicial states, like Texas, like Missouri, like Georgia, like all these states, it's key. Now, facet is also, we have debt licenses as note buyers. Certain states require debt licenses for note buyers outside of having a servicer. So states like Illinois is a state we typically stay away from because it requires a debt license and annual cost to it and an assurance bond and whatnot. So some states are worth it, some states aren't. So if you're able to create paper in states that we don't need a license, it's more attractive.
Right.
So what other facets, Nathan, do you think that these people who are creating notes should come into play where it would make their paper more valuable?
The biggest one is that interest rate. And as much as we talk about, charging a higher interest rate. So in the creation of that paper where you say, okay, I'm going to sell you this property for, 150,000, 200,000, whatever the number is, where I found the most success in making it the most attractive is high interest rate. And then you can offset that to the borrower. They say, well, holy smokes, 9-10% interest rate. That's really high. And you say, okay, yeah. And we're going to stretch it out over 30 years to help keep your payment low. If they are able to do a higher payment, that's even better. And then you can shorten up that amortization to 20 or 15 years or whatever the case might be.
Yeah.
But this is where that note math comes into play. And you got to know how the different big five affect each other.
Yes.
So that you can mess around with it, making it a really nice.
We just talked about this in our last week of a 5-week course, and actually 10-week, but we're in the 3rd week of our 5-week. We talk about note math. And if you don't know the note math, you're buying a note. And the math that goes into this is key from origination to buying it. So
on the creating side, that you got to be, so here's the other challenge, right?
Yeah.
You have to be able to do some kind of calculation. This is what we teach in the Creative Dealmaker Academy, is that once you go to closing with that borrower and they sign it, it's game over. Okay. It's done. If you agree to a 4% mortgage and you sign it, you got 4%. If you forgot to put servicing into the deal, you can't add it later. If you didn't escrow taxes and insurance, guess what? Too bad,
So
you know?
let's clarify why interest rates is such a key. It's your return a year. Plain and simple, right? If I put my money in a money market right now, 3%, I'm making 3% a year. If I put my money in a 4% note, I subtract my servicing fee if it's not included in the note, or I'm going to get 4% of my money. Now, if I'm using OPM, do you think I can borrow money at 2% right now and get a 4%? No, right? If I'm using my own money or anywhere else, I can put money to work right now at 10% passively. So I'm not going to take the risk level. So I'm going to have a discount to maybe 12, 15%. So if you write a 4% return a year, and I'm going to bid it at say 15, you have to understand the note math changes. The interest rate goes from a 4 to a 15, and watch what happens to the PV, your balance alone. That's my purchase price.
Yeah,
That's how it drives it down.
It's massive.
And
Yes.
you can, technically you can change whatever you signed on closing day. You
Yes.
can change that later, but it's probably going to be a pretty tough sell. If you've got your
Oh, you can surely
locked in
change
at
it if you can get the
4%,
agree to a
yeah, you
loan
can go
mod or
and try to
something.
modify, but you're going to say, okay, so just kidding, you're not going to pay 4% anymore. Now you're going to pay 8. That's
So-
going to be a really
well,
tough sell.
So what we teach and what we try to show inside Creative View Maker is that, let's just say, instead of writing one note,
Mhm.
we break it down and write 2. Okay, instead of
Yes.
writing,
So
instead of
let's
getting
get into that
10,
in a second. Someone mentioned a comment about creating notes. I want to ask you before we get to 80-20 rule. People write this thing idea of putting 10% down. So how does 10% down affect a note buyer? Right? It's a warm, fuzzy feeling, but it doesn't go into my math at all.
Mhm.
Right? Because if it's underwritten correctly, I know the borrower can do what it does. Max approved it. He says, listen, the borrower can pay it. I'm not so concerned. Now, do I look at it? I will look at it if they put $1 down or $1,000 down, 300,000. I'm gonna say, whoa, what happened here, right? But it doesn't mean as much. So the down payment really doesn't apply to me too much because the note math doesn't include that. So I see Drew put that he's writing a 9.5% note with 10% down and 30% AM. I'm going to tell you now that 9.5% note is too cheap.
yes.
Right, Max, I know you're in the background. What's the kind of average from Call the Underwriter? He underwrites loans throughout the country. What is the average rate notes are being created at now that you've seen?
Bet. Yeah, you bet. Well, you'll probably be unhappy to hear this, but they haven't in the last 2 years, they haven't escalated at the rate of inflation.
It's
When
low.
when the APOR was 2.89 a couple of years ago, we still had good note creators putting 9.5% and 10% interest on their notes. So the spread obviously was very good. I was writing probably 8 out of 10 of the notes we were creating were HCMs, high cost mortgage loans, meaning the definition being that is a rate that is 6.5% above the APOR or the street rate of the day. Probably 8 out of 10 files were. Now, 1 in 20 files are an HCM loan, because in order to keep that same spread, when the APOR now is 6.5, you'd need to be in excess north of 12.5% on every one.
So Max,
So
when
there's no arguing that notes are not getting as good of a spread now as they were 2 years ago, period. There's no getting around that.
yeah. So Max, you talk about APR, and that's just the prime offer rate. It's like LIBOR, right? It's an index. But so
street
my
rate.
question to you is this: How do the state usury laws impact the ability to write these mortgages?
Clarify what usury is for those people who may not know what
Yeah,
usury
Max.
is.
Yeah, you bet. Okay, so usury is a state limitation on the amount of interest that can be charged on certain loans. It's not the same in every state. The Dodd-Frank side that we help maintain compliance on, a lot of people are always surprised to hear this, but federally, there is no max interest rate. So federally, if your borrower can meet the 8 elements of ability to repay, meaning state-specific residual income, debt-to-income ratio, credit worthiness, 2-year work history, 2-year income history, all of that, all else being equal, your borrower can meet the ability to repay. The feds don't care if it's a 30% interest rate. All they care about is that that PITI still fits within this borrower's realm of comfortability with respect to gross monthly income. But then you enter the state specific arena, and that's where the interest rate matters. And so I always try to tell people, when you're originating, you individually need to sit down with your team in your state. I'm not an expert in all 50 states. I'm the first to admit that. So the investor, that originator, needs to understand in the state that they're originating, are there any limiting factors to the interest rate, and then let that guide where they go from there. And unfortunately, there is a state or two that they're set so low that it doesn't really make it. Right now, you know, when the APOR was 2, then they could still write them at 8, and that was great. But there's a state or two out there right now that I can't imagine anybody wanting to write paper in, because you can't even hardly compete with a bank.
So would you say 9.5 is average, just below average? Where should
Not-
people be kind of aiming at right now?
Yeah, right now 9.5 to probably 11 is very average on stick built. Now I do a lot of mobile home work. I'm doing mobile homes up into 15.
Wow.
So mobile homes is a whole different matter though, and a lot of people don't want to touch them. So mobile homes tend to run a lot higher. But yeah, stick built home, real common now to see, you know, probably 10 and a quarter is probably pretty average right now.
Understand you
But
don't
that
want
tells you that spread is a lot narrower now, right? You got
of course,
an APR almost 7, and an average note now is 10. That
100%.
doesn't look as good as a year and a half ago when the average note was 9 and the APOR was a little bit over 3 or a little bit under 3.
And a lot of times people want to guide to their borrower and say, listen, I'm going to help the borrower out. Granted, you have to by law, and I think you should make sure they can pay, but you also understand the fact that if you want to refi out, or if you want to sell it off, right? If you write a note at 11, 12, the borrower can refi next year. They can get you out, which is great. You get paid off earlier. But if you're down at the 8s and 9s, get as high as you can without screwing the borrower over, because if you're looking to cash out, you need to do that, right?
And without going over the
I'll tell
state
you-
usury.
I'll tell
Yes.
you what we do a lot of times, and just so anybody out there listening knows, if they bring something to me and want help with that, I do all the time a situation where we just basically back into the payment. And so a note creator will come to me and say, you know, what's the max that this person can afford? So I've structured a very general deal, but we haven't settled on an interest rate yet. And so I'll calculate all of their gross monthly income up and essentially say, you know, this person, if they'll go for it, you can squeak them in at X amount of interest rate and still keep them under DTI and keep them within residual income. Anything more than that, then they'd have to bring more money down or lower loan amount or whatever. And so I kind of help them figure out what the max is that they can get.
Correct. And one of the terms
borrower
is,
still meets.
but also the term is a big thing for us too, right? Understand the fact that if the term is
How long?
lower,
Yeah.
our discount is not going to be as much because the change of term, right? If you're working a 30-year versus a 10, my discount won't be as much. You can do the math and a financial calculation, but my discount won't be as much because it doesn't take much to change that yield number on a 10-year versus a 30-year, right? Now,
Right.
back to what Nick talked about, the 80-20 thing. Those are creating notes. I encourage you guys to submit loans to us. We'll price them out for you. We have pretty much automation systems that do a lot of the stuff. But 80-20 loans, I think, are the way, if you're creating notes, to do it as best you can. I don't like the whole idea of land contracts, because technically then you create an 80-20 land trust. Who owns the property if you sell one of the land contracts? It doesn't work. And I'm curious if anyone's ever done that. Please put in the comments or whatnot. But 80-20 is basically saying, if I'm going to create a $250,000 note, I'm going to create a $100,000 first, a $150,000 second. I can sell the $100,000 first to whoever and then keep the 150 as that. Or if it's 300,000, I can create 250 and a 50 and keep the 50 and keep payments rolling in and get my cash out of the first one. Nick, is that kind of how you guys do it?
Yeah, we actually have lowered. So when I started doing this, it's a moving target. I will never negotiate interest rate with anybody, period. My rate is my rate. And if you don't like it, then don't buy the house. Okay. I'm not going to manage the problem, right? Because I already know what the answer to the question is when I go sell you the note. Okay.
Yeah.
I already know all things considered. I already know what your yield's going to be. And if rates are going up and inflation's changing and people are changing it, like you said, I just showed you when we started how CD rates were 14%. Now they're not going to go to 14% back in 1982. Not going to get there again, but the higher other things start paying relative to a 10% yield or return, the harder it is for me to compete, like for your money, right? Because you have a decision to make, because you're an investor, right? You're going to say, I got $100,000. Where's the best place I can invest that $100,000 relative to risk and return? Well, if you can get 12% in a CD in this example versus 10% on a secured mortgage note, like with some borrower, you're probably going to take the CD. So we want to create that gap as much as possible. And the only way I can create that is by controlling the interest rate. So I know when we discount it back to you. So what we started doing is, before, here's a big challenge. Okay. And I don't know, I'm curious to see where you are on this, Dave, is that when we first started doing this, I was writing first liens at 78% or less. Okay. And now I'm down to 70 to 72 because what's happened is that real estate prices are not increasing like they used to be. They're flattening out or even going down in some places. And so when we do the note, one of the things that determines what you're going to pay is what it is, what's the investment to value, right?
Yeah.
The ITV, not necessarily the LTV or the loan to value of the borrower, investment to value. So if I'm wrong on my assessment of value, and you come in and say, well, I don't think it's worth 200,000. I only think it's worth 190. Well, then you're setting it and I lose that opportunity. So by going to a lower first lien, I get the benefit of having it being in a better position. And I just move that to the second lien, which is my profit or my staying in the deal. Yeah. That's how I minimize getting hammered on the discount when we go to sell, and it's a better deal for the note buyer at the same time.
It's interesting you asked this question. This is a question me and Nathan left about the last couple of months. ITV and LTV was something we never looked at because we didn't have it, right? We most of the time, our LTVs in 2010, 11, 12 were upside down. We were underwater and everything, right? So LTV was like, we can get below 100, like, right? Like, so for us to look at now and see, I'm concerned, it's a little interesting, right? The ITV is definitely there, but because ITV is the fact that whatever's lower is the balance of the loan or the value of the property, which was lower. I'm going to basically go off that number. But so we're looking now the fact that where do we think the market's going to go? Is this going to go up or down values of properties? If the property values are going to go down, I want to make sure my ITV is lower because of risk level. My LTV is there too, but I'm not concerned too much about that as much as Max is, right? Where my concern is now is I am curious where we're all at. I'm shooting around 65, 70 because I'm not sure, but I'm kind of staying that mark for LTV reasons, right? ITV, it still comes back to what's my return per se, because I can always get rid of the deal. So I'm actually not plugging in too much of the ITV stuff. I am concerned with the LTVs as they come across. But I know the fact that the market is kind of flattening. I don't see a drop. It just stays on markets are extending, whatnot. Nathan, what's your thought about ITVs and LTV?
Yeah, it's a weird one because, like you said, we used to deal with negative LTV all the time. That's all we ever saw. Yeah. So now when we're in a position now.
Do banks write negative LTV loans? I'm just curious.
No.
Okay, I'm just making sure.
Yeah.
That's what we were
so
earlier.
Now we're in a position where the market is dropping and dropping, flattening. We don't know. And that's kind of the thing. So if we've got a 10% down payment that somebody made, okay, so there's 10% equity in there. That's great. And then what? What happens when the property drops by 20% in value and the person stops paying? So it's a bit of a tricky situation for note investors because, like Dave says, usually we'll pay based on the lower of the balance or the property value.
Yeah.
And if we're seeing property values drop, how low are they going to drop? And we're kind of having to do a little bit of guesswork there to see, if we buy it at a percentage of the unpaid balance, but then the value drops below that, are we still protected? That's
Well,
the major question.
That's a great point, but it's only a
Juggling.
problem until it becomes a problem and the borrower defaults, right?
Yeah.
So you got to have a lot of things happen, right? It's that 1,000-year flood insurance, right? Same thing. But if we do a good job and follow best business practices from the beginning, we use an RMLO, we service the debt, we take a 1003 application on the borrower, we escrow taxes and insurance, we get a valuation from a BPO or an appraisal on the very beginning, and we stack the file correctly. Everything you're talking about is not nearly as impactful if you didn't do any of it. So, and then you throw in the fact of going to a lower ratio on the property. That's why when we create these notes and we teach it in the Creative New Maker Academy, it's a win-win-win deal, because the way I look at it, the note creator wins because they're going to get they're going to give up less of a discount and they're going to get more money back. The homeowner, the new homeowner wins because now they have a chance to have a home ownership when other people have told them no. And then the note buyer wins because they're at a lower investment to value, so their risk is down. But here's the thing. They also have the note creator staying in the deal in a junior lien position, which is where all their profit is.
Yeah.
And I agree.
They
And I
know
think
more
that's the
about
right way to
area
do
and
it
the
right
property
now.
and everything. So
Yeah.
you have a little bit of the golden handcuffs sort of tied to it, and collectively all that and having a really well-stacked property file. Look, we can't predict the future, but I tell you what, I like my chances because I've seen the portfolio over the years, and our default rate on stuff that's been created either in-house or through our under our toolage, it's 1/100th of what the national average is. So look, it doesn't mean that they can't default tomorrow and we can't have COVID 2024 hit. No, of course we don't know that. But
you talk about value of properties. You know, what I did years ago is I created a due diligence portal, allowed me to kind of aggregate everything that I can get online, paid, non-paid, and come together with an idea number. When we bid on an asset, we're bidding on a guesstimate of what the property value is. We don't dive into getting a BPO right away. And to answer the quick question, LTV is loan to value, ITV is an investment to value. So I use my due diligence portal JKP Holdings, and it allows me to get data numbers, right? And then through we have our course, our building confidence course, we teach you guys how to figure out with all these values, how to calculate these things, right? Yeah. And then we have to also say the fact that it may not still stay performing. We also have to know the fact that it may default, and it means I have foreclosure costs, holding costs, servicing costs in play, that if it defaults, what do you do? Right? Because you can't, I don't care if the loan's been performing for 10 years. Doesn't mean someone's not going to pass away, someone's lose a job, someone's to get sick, right?
But I think the way that Nick and his group are doing it with the first and the second, I think that's really the way to do it, especially right now. That protects everybody involved, and it makes the note buyer feel all warm and fuzzy because then they've got a lot of
Absolutely.
Dave, to your point, if the property's worth 200,000 and your cost basis is when you buy the note after discount is on the first lien, because you really don't. Most people, I shouldn't say all people, don't care who's behind them. Do you agree?
Okay.
I don't care if there's 15 liens behind you.
Okay.
If you're in the position you want to be in, usually first. So if you're in the first lien position on a $200,000 house, and your cost basis is let's just say 140, okay, and that property goes down 10% in value and the borrower defaults, I got to believe at some point in whatever that number is, you feel pretty darn comfortable you're going to get your equity position back as a result of it.
So when you say that, why do we care about equity position? When it goes to foreclosure auction, right, that property is going to either sell third party or default back to us, and we have to sell it. So if that value of property is 200,000, more than likely it's to sell at auction, or when I get back, I could probably sell it for 140 and get my money, balance out.
We do know this for a fact. You have a lot better getting your money back if you're only in it for 140 than if you're in at 160 or 170 or 180. Would you agree on that, right?
Yep.
So that's all we're trying to do is mitigating our risk.
We'll never buy a loan over what the UPB is for multiple reasons. If they pay off tomorrow, I don't get my money back, right? I can only get up to what they call legal balance, which includes tax insurance. We talk about it in our building confidence course. But you get all that kind of stuff. But you need to be calculating if you're buying these notes I don't care how long it's performing, you've got to calculate the fact that if it defaults, because things do. And it could be no control of the originator. It could be no fault at all. Both parents die and the kids have the house and they can't do anything with it. Like, what do? Right? Things happen. It's out of our control sometimes.
And they happen more often than you would think. I mean, Dave and I grew up on that, like you said.
Look,
and
it's a 30-year, it's up to a 30-year mortgage, right?
Yeah.
Life happens in 30 years. Something happens.
I
and
lost
it
my
has to
hand
be
30
addressed.
years, you know?
Yeah.
So,
Nice.
you know, I think 80-20 rule, if you guys are doing it, it's great. And if you can sell those notes to us, we can give you that money. You can go buy another note or buy more, right? We talked to someone recently who said, listen, every $10,000, I can go get a subject-to property and get into it for 10 grand that has $100,000 in equity. Can you keep funding me? And the answer is yes. All day long as my yield number equals, I can buy as many as you want to sell me at a good number.
Yeah.
My position on this stuff moving forward is that I will always write 2 notes.
Yep.
And I want to write my first note at the lowest dollar amount I physically can write it at, that puts me in a position that I'm comfortable with from a cash position, right?
Gotcha.
So if I can write it at 52 cents on the dollar, if I can write I sell it for $100,000 and I can afford to write it at $52,000, I'm going to write the first lien at $52,000 because that's just going to be a lot better for everybody involved. And plus, I get to stay in some of that deal as well in a junior lien position in the second note. And then I don't have to worry about as much on how somebody's going to be able to come in and, take that away. And most people
Let me clarify. First and second liens has nothing to do with how much money the lien is worth. A first lien can be 20 and the second be 200. It's the order of the county records of recording, right?
Great point.
Taxes jump over it first, second.
In fact, we're seeing a lot of first notes being smaller value than the second notes now because of the equity position that's happened because values on properties have gone up.
Yeah,
right. So the cost basis may only be $100,000. The property's worth 300 now. Well, I only need to clear $100,000 of debt, and I'm okay staying in the deal for the cash flow by doing it the other way. So
if you're part of Nick's group and stuff like that, and you're looking for people to buy notes, pick our brains, reach out to us, right?
Please do.
We'll buy it, right? If it goes
buy 'em.
non-performing, you get really scared, we'll come and save the day for you, right? That's what we did for years.
Yeah, don't call me on the non-performing. Call Dave and Nathan, man.
We're very interested in the non-performing. Absolutely.
Right? And if you're looking at partials, which we didn't get into this call, it's another option to do. We've had webinars on partials. We probably should do another one again soon. But partial is another way to get some of your money out. It's similar to 80-20. I'd rather you do an 80-20 than do a partial, but you can do that whole facet. I'd rather buy the whole loan than actually buy partial, but I can make both work. Nathan's trying to figure out how he can make it work on his side. So Nick, for your experience, these people getting in, what are some of the big mistakes as we're closing up here that people are making with either originating or selling a note?
Well, I think on the origination side, I think they really need to understand you need to work it from the end backwards. Okay. So even if you don't intend to sell a note, you probably need to structure it and look at it as if in the event that you do. Okay.
Right.
This is on the creating side, right? So you want to make sure you do it so you don't have to go have a fire sale and end up having to scratch a check to get out of the deal. That's number one. So you want to know, like, what would somebody, what would the indicative bid be on the note if it's created this way and it's underwritten from the RMLO and everything's stacked correctly. You need to know what the market will bear if you're going to create. That's my opinion. Okay. On the note buying side, it gets back to, what's your propensity for risk? Okay. Because everybody has a different definition of risk. And some people, and a lot of people have a different opinion on what a solid return is. Okay.
Yeah.
Right. Because if you're a family office and you're sitting on $100 million, you're not trying to make 12% return on your money.
No.
Right. You're trying to preserve your $100 million and you're trying to get a solid return that outperforms inflation. That's what you're doing. So you want higher quality stuff. So it's really just, you have to understand really where you want to be in this and what, I'm older. I have a lot less chances to go back and fix do something over and over again. If I was 25 years old or something, I may have a different opinion on how to structure this stuff out, right? I might be a little bit more willing to take risk, take something that's a little bit on the edge of being a reperforming, non-performing judicial state note because I can get it at a thing. And I don't really care if I got to take it back because that's what I think is cool. And I'm happy to do that. I don't want to do that anymore. So I think those are the things. I don't know if that answered your question, but you just need to you really need to whiteboard this out and think it through and not just say, hey, oh, that looks like a good note to go buy because I'm going to get a 10% return and it's down the street from where I live. Because if you live in Chicago and it's down the street, that might not be the best place to be investing in a note.
Yeah.
Because it's all relative. So anyway.
Before Nathan, you asked your final question. Drew, I wanted to comment your question about creating mobile home things and his different family homes. I suggest you reach out to Max, call the underwriter, go directly. You can Google it and you get information about Max. I reach out to him directly, ask him what specifically you would need for mobile homes and whatnot. And someone asked also, can we price out a note that you want to hold for 12 months and whatnot? You want to create this month and you want to know what we pay a year from now. I can do the math on that, but don't hold me to the quote of my price, right? Because if
let's look at it. Let's compare apples to apples. Okay. What's the difference between a new note and a 12-month season note? Let's all things equal. How much is it? Another 2 points, 4 points, 6 points?
For me, it's 2 points.
Yeah,
2 points.
A huge difference. Yeah.
So this is a great question here because
we should ask this earlier. I know we're losing people here, but
if it's let's talk about this because my position is, you got to ask yourself the question: is the upside gain worth the downside risk? Okay, so if I hold it for 12 months, and there might be some tax advantages of doing that, but that's beside the point. I can get an extra 2 points. So in that situation, if it's $100,000 value, I might be able to get an extra $2,000 according to you, Dave, right?
Yes.
Let's just say that note doesn't perform in 12 months and it starts underperforming. Now, what's the value of that? What's the deduction on that?
So it's a dramatic discount depending on the states and stuff like that.
It goes downhill a lot faster than it goes up. Do you agree?
Yeah,
Right.
absolutely.
It could drop 5, 7, maybe 10.
I may be targeting, say, 15, but if it goes not performing, I may be targeting 25. And the reason is I can't get inside the property. I can't see the condition of the property. Will the borrower file bankruptcy? What will happen? We can't predict. So my risk level goes up. So I got to aim higher for my returns, right? Mm-hmm. And just to clarify what seasoning means, everyone considers seasoning different, right? Table funding is at the table, you double close an idea. Some people want 3 months, some people want 6, right? We're targeting around 3 months right now. Nathan will buy at the table, right?
All table,
right. But if I bought the table, I'm going to increase it 2%. It's just what we do because the risk level of is this borrowing to continue performing? Mm-hmm. If not, I got to default and consider that. If they do perform, the risk level is still there, but I would like to make sure I'm covered.
Yeah.
So we could price that a loan a year from now, but we don't know where the note will be, nor will we know what returns we're going to want a year from now.
It may not be exact, but it'll give you a ballpark anyway.
Hey, what if CDs go to 14% a year?
Right.
Why would I buy your note at say 15 when I get a guaranteed return in a matter of at 14? It's not about the fact that, CDs are 14, you can buy at 15. It makes sense. No, because there's still risk in our note space.
Yeah.
Mm-hmm.
So if CDs are 14, I'm probably at 22. I'm a much higher number.
But the inverse applies too. If it goes the other direction and the market starts tanking,
we're targeting 10% 3 years ago.
Yeah.
We were there because what the money was, where it was. So it's a matter of where can our capital go and what return we need on our capital. So I think that's all the questions we have on here. So Max, is Tennessee one of the low usury state? Max doesn't get involved with the usury law, right? That's something for you to do. He does the underwriting side of it, right?
But yes, he underwrites nationwide.
Yeah, he's nationwide kind of underwriting. So if you question about underwriting, that's Max. If it's a question about usury law, that's your local attorney or your originator in your state.
Yeah.
So
So-
Max doesn't originate. Max only underwrites.
He's just an underwriter. Call the underwriter. That's him.
Just so you guys know, just a quick point of clarification. We are doing full loan originations in 18 states,
Okay,
and we're adding more all the time. So to muddy the water a little bit,
Okay.
we will underwrite in all 50 states, and that's typically what we do. But because the demand has been so huge and continues to grow, we are offering full loan originations in 18 states.
are
and
you
hopefully-
an MLO in those
Continue.
states or?
Yes, yeah, me and an affiliate. So
Okay.
So you're
correct.
using it, you actually have an NMLS license to do that then?
Correct. Yes, sir.
Got it. So you are actually the lender of record on those transactions.
We would do an assignment at closing to the seller. Correct.
Gotcha.
Yep.
Fascinating. All right, good to know.
Yeah, and we're adding more states all the time. So
So one question when you do that, then are you following traditional for you to do that? Does it have to check all the boxes as a traditional bank lender would have relative to the DTI credit score?
well,
know-
they're understand that almost everything, 99% or better of all seller finance notes are non-QM. And so we're following standard non-QM origination and underwriting
Mhm.
principles. So are they more flexible than Fannie and Freddie, who's selling to mortgage-backed securities that are very risk averse? Absolutely. These aren't QM loans. But with that said, they're still compliant, they're still legal. And so, yes, it's not the Wild West. We have a metric that we follow to make sure that you guys are safe with the paper that we're helping you generate. But thank God it's a lot more relaxed than what Fannie and Freddie lenders are having to go through, right? Which is why if you're under a 720 now, they just draw a line in the sand and they only pick their low hanging fruit and they leave the rest for seller finance.
So it's
Because-
720 now. It's up to 720 now. Wow, that's-
Well, that seems to be, because think about it. I mean, if you were trying to meet the Wall Street mortgage-backed security, that's a pretty high bar. And so the easiest way to do it is just draw a line in the sand and don't even mess with anybody that won't easily fit over that bar every time.
nice.
So some people are asking some general questions. Be sure to reach out to Call the Underwriter, where he's licensed and all that good stuff. So I would definitely reach out to Max, give him a yell, whatever, go on the website. And we can.
Alltheunderwriter.com.
Yeah.
Yeah, and you can if you guys aren't in our Creative Dealmaker, join the Facebook group. That's probably the best place to start. And it's just creative. If you go to groups in Facebook, it's just under Creative Dealmaker, and you can probably put something in the show notes, Dave, or whatever.
Yeah, absolutely. We'll
Um,
put in the YouTube channel and stuff.
and,
and our
you
Facebook
Put it all in
page.
there, and you reach out to Eric and myself. And
We run this
Yeah.
webinar, different topics every couple weeks, every 2 weeks or so. So yeah, connect with all of us. We're all connecting each other. We're gonna make each other's life a whole lot easier. Go ahead, Nathan. I'll let you go ahead.
Yeah, sure. So we've gone over time. So we like to kind of finish off with this and get your crystal ball. Where do you think the market's going? But we are over time. So let's try to keep it concise if we can, just for people listening in.
Nick, where do you see the market going in the next 6 months?
well, I think from the ability to create opportunities for homeowners that can't get bank financing is only going to get bigger. The seller carry market's gone from 20 billion
Yeah.
to almost 30 billion in a very short period of time. And the average dollar value of these seller carries are, these properties are over $250,000 now. It's not like back in the day when it was a bunch of crappy houses that a bank wouldn't produce financing on. So it's just an easier path for most to do, but it's also a dangerous path if you don't integrate best business practices and use a transaction coordinator that knows how to do this, an underwriter that knows how to do it, or a servicer. You can really get yourself into a pickle. I don't necessarily mean legally, but I'm talking about from a valuation standpoint, because it'll make a huge difference when people like Dave and Nathan and even ourselves go to look at purchasing that note.
Yeah, absolutely. And I agree. I think there's no slowing down of the seller finance.
No.
I think that we're going to see more and more and more of that.
Yeah.
So learn how to
Remember
do
when
it
things
right so
go
you can sell
crazy?
off a mortgage.
Yes, we want to buy as much as you guys can produce. Let's put it that way,
Absolutely.
right? And Nick's doing it too.
But you want to buy quality stuff, right? You don't want to buy a bunch of crap.
Yeah, 9QM is something we don't get involved with, just because, you know, it's spotty, but if it's a clean non-QM where it's like some stupid, we have no problem buying non-QM, which is non-qualified mortgages for those who don't know what that means.
And I probably buy more than Dave. I'm a little bit more risk tolerant, and I'll look at that kind of stuff as well.
Nice.
All right, we're gonna tune off to the from the social medias. We're gonna finish up with Nick. Appreciate you, Nick, jumping on, allowing me to connect with us and do everything we all do together. And hopefully we'll be doing more business with each other in the near future in 2023.
Awesome. Thanks, guys.
Awesome. Thanks a lot.